Good morning. This is Larry McMillan with a market update on Monday, December 28th, before the market opens. So we have begun the Santa Claus rally period as defined by Yale Hirsch years ago. It includes the last 5 trading days of one year and the first 2 trading days of the next year. Normally, that's a bullish time period and everything is fine. But in some years, that has produced a loss for the market. And those years, the last 5 times it's happened, go back to the year 2000, January of 2000. And all of those have led to a very nasty January. So this is something to definitely keep an eye on. The market was up on Thursday. The S&P futures are up overnight tonight, so perhaps it's nothing to worry about. The S&P chart itself remains bullish as long as it holds above 3630. It has bottomed out at that support area about 7 times in the last month. And there's also support below there at about 3550. The equity-only put-call ratios are beginning to roll over to sell signals, though, and while this is sort of a reversion to the mean process because it's our computer analysis programs that are giving us that designation as sell signal, and these ratios have been so low that, so overbought, so much call buying that it wouldn't take much to turn them back upwards a little bit. So we'd like to see some confirmation from the S&P 500 index if these ratios really do begin to rise. But still, this is a change and definitely something to pay attention to. Breadth is also beginning to falter a bit. We had what turned out to be a false sell signal last week, but again, we're in a situation where if we have negative breadth for a day or two, our breadth oscillators will roll over to sell signals. Right now, they're still on buy signals. VIX has probably been a little more positive than some of the other indicators because of that big spike upwards that it had last Monday when it was worried about the new coronavirus strain and shutdown of the economy in Europe. But now VIX has declined for the last 4 days, and we have a VIX spike peak buy signal in place, which is good. A move below 20 would be even better for the bulls. However, VIX is stubbornly staying around 22, which is about where its 20-day moving average is. But still, it reflects the fact that there are plenty of worries going forward as traders are still loading up on SPX puts. That's controlling the price of VIX to a great extent. Also, the construct of volatility derivatives remains bullish because Jan VIX futures are trading at a lower price than Feb VIX futures. But after that, the term structure is flat. So if Jan inverts with February in terms of VIX futures, that would be negative too. So overall, we're remaining bullish because our somewhat aging bull signals on our indicators are still in place. And of course, this is the seasonally bullish period. But we're not being complacent because these other potential sell signals that I mentioned could occur. And I just have a gut feeling that, the last 2 times we had strong Decembers, which are 2 of the last 3 years, 2017 and 2019, the market topped out quickly and nastily in February. Somehow I feel that the market won't do exactly the same thing. It rarely does. So we'll either probably have the top of this move early in January or not until much later in the year. But that's just a gut feel. In reality, we have to stick with our indicators. And so right now they're still bullish, but we're paying close attention to what they're saying. I invite you to check out our website. We're having specials on some of our premium newsletters right now, and this has been an excellent year for our newsletter recommendations. So I invite you to visit optionstrategist.com and check those things out. So thanks for watching. Have a great week finishing up the year, and we'll speak again in the new year.